All right, good morning, everybody out there. John Caruso, September 9th. Happy Friday to everybody out there. Taking a look at the market, we do have some strength across the board. This is really the first day that we've seen any kind of uniformity in the tape. The S&P 500 is up 0.81%. The NASDAQ's up over 1% here this morning. The dollar is starting to come in. We're back down along 109 in the U.S. dollar. We did see a pop up to 101 in the euro in the overnight. Gold prices are seeing some strength as well. We're starting to see some strength underneath bonds a little bit here. However, yields are still very much bullish trend. So how do you play it here today? Well, you should have a combination of both longs and shorts in this market, okay? So what longs are you looking at allocating to on a day like today? Probably the U.S. dollar. The U.S. dollar is now giving me an immediate term oversold signal, while the euro is giving me an immediate term overbought signal. So on the other side, you should be looking at probably trimming back some of your gold. Some of the gold that you've been buying over the last couple of weeks, start paring that position back, reallocating to long dollars, reallocating to short euros. And we're even going to look at fading the equity market. We're going to come in lightly on the short side in the equity space, as we certainly still do not think the market's out of the woods. We are only on the precipice of seeing QT accelerate from here. So QT, of course, quantitative tightening. The Fed is scheduled to run off approximately, I've heard anywhere between $2.5 to $4.5 trillion off the balance sheet over the next 2 years. We'll see how far they get, but they are only getting started, and that is certainly going to be sucking a lot of liquidity out of this market. And mind you, the growth cycle is only set to slow exponentially, we think, from here over the next 4 quarters. So that's how you want to be looking at playing it. Some more headlines from the overnight. We did see Chinese CPI actually cool off 2.5% versus 2.7 prior. PPI 2.3 versus 4.1% prior. I did hear an interesting angle discussing the Chinese lockdowns yesterday from a PM that I really respect and hold his opinion in high regard. But he was suggesting that the Chinese zero COVID policy lockdowns over there might have more to do with them curbing inflation rather than zero COVID policy. So when you lock down 300 million people inside of your country, you're crushing demand, and you're not having to raise interest rates. The People's Bank of China doesn't have to raise interest rates if you got 300 million people locked down over there. That's already doing the work for the PBOC. So interesting angle, something to think about, maybe a little conspiratorial, but I certainly wouldn't put it past the CCP to implement something along those lines. So that's all I have for you here today. Best of luck to everybody out there. If you have any questions, feel free to reach out at jcaruso@rjofutures.com or reach out at 312-373-5286. Have a great day.